when I meet somebody new, I'm like, okay, man, just add me into your list. I'm not going to invest in your deal. Like, don't even ask with me. I don't want to
Yeah.
sound like a jerk or anything like that, but I'm not interested. I want to see some deal flow. I want to see how your other investors take to the deal. If you're having trouble raising the deal and you're sending me 5, 6 emails, I know the deal is not very good and your investor list isn't very good.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with homeinvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today. All right, welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer, and I have Lane Kawaoka with me. Lane, how are you doing today?
Hey, good. Thanks for having me, Todd.
Absolutely. I appreciate you being on the show. And Lane, I'll let you kind of give an introduction of what you got going on and why you're here. So why don't you get us started and what you got going on today in business world and where you kind of a little bit of your background as well.
Yeah, today, I guess I'm investing as a passive in multifamily syndications and doing all sorts of investments. But yeah, today I'm still working the day job as an engineer. You got me up at 5 o'clock in the morning just for you, Todd. Here in Hawaii.
Yeah.
But yeah, I started maybe about almost 10 years ago buying that first single family house. That's how it all started, and it kind of snowballed from there.
Cool. So you're working the day job. How are you balancing then working the day job and still building your investment? And you've got a podcast as well, so you're doing that too. So how are you balancing that?
I mean, I think I've started. I started my career in the private industry as a construction supervisor, and then somewhere down the line, I think 5 years working doing that, picking up rentals along the way, reading that purple book. I realized that this buying rentals and being a real estate investor was probably a better way of going. So I've kind of downgraded my job to take more government jobs, a little easier, a little bit better quality of life, so I can kind of balance things more. But
yeah,
and I don't have kids now, so it's so it's like I've got some free time to do this stuff. So that's why I'm trying to make hay while the getting's good.
Sure.
I see a lot of 40, 50-year-old investors out there, and it's hard with the kids, I guess, is what I'm saying. So
and you bought some I know you bought some turnkey and some single families. Can you take us through kind of that, and then why did you switch? Was there a certain reason why you switched?
Yeah, so I had a couple rentals in Seattle where I originally lived for the longest time. And, I didn't know anything about cash flow versus appreciation. They were essentially A-class rental properties that barely got the 1% ratio back in 2012, 2010-ish.
Hmm.
About that time, they weren't cash flowing. The next purchase wouldn't cash flow, right? And I was like, well, what the heck? Like I'm not able to cash flow in Seattle, this primary market, right? So I bought a property in one of these turnkey rentals in Birmingham, and it seemed to work out. So I 1031 all my properties in Seattle for 9 properties out of state in Birmingham, Atlanta, Indianapolis, and I did that for a while. I definitely was beating on the drum that I'm gonna get like 30 or 50 of these houses, and I'm gonna retire that way. But you know, with 10, 11 houses, I was running into like one or two big issues, or one or two evictions a year, and maybe 3 or 4 big issues that happened, like someone stole my HVAC, or some big thing, some flood happening. And then I was like, well, okay, 10, 11 houses is pretty easy to manage with a manager, which I was
Yeah.
doing from afar. But for like $300 a piece, do the math, that's only $3,000. I mean, that's not enough to retire on. I mean, I needed more like 10,000 plus per month. So I needed like 30 houses. Just do the math. That's like an eviction every other month, and then a big catastrophe every month, just with the law of averages. So then I kind of looked to a multifamily, and kind of followed the progression of most real estate investors, I think, to that point.
So when you're doing these turnkeys, were you doing some of the evictions or stuff, or was it the management? Or
All the management. I mean, I was living in Seattle at the time, and
yeah,
I totally hands off. But you know, I mean, I don't. I mean, with 11 houses, I mean, it's not that bad. But definitely, I saw the writing on the wall with 20 plus rentals. It was going to start to get a little out of hand,
yeah,
and I felt like
it
with a
wasn't going to
single
be
family
passed.
house, you've got like the 4 walls and the roof and the outside for the
Yeah,
tenant to screw up.
yeah,
And with the apartment, it was just a little more self-contained.
sure, sure. So, like how many? What would you say estimate? Per week or maybe per month, were you spending on the turnkeys then as just oversight?
Yeah, I mean, there's definitely a difference between the time that I spent on that thing and necessities time to spend on it. If it was just necessities, yeah, probably maybe about an hour or two a week was enough, more than enough. But I'm like that engineering mindset where I'm like, I need to make a spreadsheet to count how much money I'm making and what percent ROI, or percent ROE, percent something else, percent or something.
Yeah.
So I really geeked out on that kind of stuff, and I realize now that you get into this and it's kind of fun counting how much money you're making, but it's kind of a waste of time. Especially when you're like screwing around with something so small.
Yeah.
Yeah, I mean, now I don't even really keep track of those turnkey rentals. I'm trying to sell those things, but how much money I'm making. I mean, I know I'm making money, but I don't have the time to like, have, hey, this is what happened in July. Just
Yeah.
I don't
Yeah.
care. I haven't even done my 2017 taxes yet. I haven't even done that bookkeeping.
You and me both, by the
Yeah.
way. We got an extension going on, so they had to do that the last several years. It gets to be hectic when you got a big pile of like.
Yeah, and it's a pain, right? Like that
Yeah.
stuff. I mean, the bigger stuff, you just get this nice K1, where like this other stuff, you got to like worry about how you're gonna put them in LLCs, how you're gonna stack your LLCs,
Yeah.
all kinds of
Yeah.
stuff.
Well, let's talk about some of this passive stuff because I think it's interesting. Coming from an investor mindset, what you're looking for, how are you vetting these sponsors? How are you finding them? Because I hear that quite a bit. People ask that question, whether it's on Bigger Pockets or other places, is how do I find somebody that's doing this? I don't know anybody that's doing apartments. How do I even get into something like that? So take us through kind of some of that. How do you find a sponsor that you can trust?
Yeah, so I guess today I'm kind of calling myself the deal hunter. So I go out and find operators because I spent about a year and a half trying to find my own deals, trying to be that multifamily operator.
Yep.
And I must have analyzed 200 deals in the matter of like 12 to 18 months, and it was just like just very demoralizing because there's just no deals out there. I don't know what it just kind of cracks me up when like the newbie goes out there and finds the deal the next week, and I'm like, no, dude, that's not a
It's
deal.
not a deal.
That's a
Yeah.
sucker deal. Yeah.
Yeah.
Um,
You're getting that deal because nobody else wants it.
yeah, yeah. I mean, it's like I don't know if I mean there's a certain crowd out there that's played like video video game baseball. It, it's like when you're drunk with your friends and they're just throwing junk at you, but you
Yeah.
can't tell because it's a freaking video game and you can't really see that the ball's in the dirt.
That's
It's kind
funny.
of like that when you're starting. Brokers just throwing you junk and
Yeah.
you can't really tell if it's good or not because you're just so new at that.
Sure.
But
Yeah.
yeah, I did that, and I just realized that I was wanting to be more of a passive investor. That if I just grew my money at 15 to 20% passively, then that was enough. Thankfully, I started early as an investor, so I could come on it from that abundance perspective.
Yeah.
Yeah, to answer your question, I mean, it's just about meeting other good deal sponsors, and I mean, they're out there. I mean, they you don't want to go to the ones that like kind of push it too hard, but I just go around and get myself on a lot of deal sponsors lists, and and the other key is you just have to analyze the deals properly because you get these executive summaries and there's nothing in there that really tells you if it's a good deal.
Right.
You need the P&Ls, you need the rent rolls, you need to do your own rental comps.
Yeah.
um, yeah.
So where do you find a sponsor though? You said they're out there, but for somebody who doesn't know how to find one, where do you find them?
Yeah, I mean, I guess like, Bigger Pockets is obviously like, place people go these days for everything real estate.
Yep.
I would say probably about 20% of the sponsors are on Bigger Pockets.
Mm-hmm.
Um, I would say kind of push through that first layer though, like if anything. I mean, I think if you're serious about being a passive investor, you need to get off your butt, get around that computer and go fly to some of these national events. A lot of times the sponsors that you want to be working with will not be at your local RIA. I feel like, especially if
Mm-hmm.
you live in a primary market, you got to go to the kind of the action where it is, and a lot of that's like where the South is and the Midwest, where the jobs are happening, where the
Yep.
cash flow is to be had in these secondary markets.
Yep. Yeah. So you're going out, you're actually networking, you're meeting with people, you're going to conferences.
Right, right. And I would also throw in another tip in there. I would spend your time and energy more finding the limited partners, not the general
Okay.
partner or sponsors.
Yeah,
I think
that's a great tip.
more people try and build their spreadsheet with all the GPs on it.
Mm-hmm.
And I don't know, I feel like it's kind of wasting your time and having your 30-minute talk with each GP sponsor because it's going to be the same stuff over and over again. I mean, I mean, Todd will probably be honest with you. Probably had the same talk with people like millions and millions of times. You probably could do it in your sleep.
Yeah, I mean right. It's your, if you want to call it a pitch or whatever you want to call it. I mean, it's the same. And people will ask you mostly the same types of questions. Some people will throw a curveball in there, and you gotta make sure you
Keeps
can.
life interesting, right?
Yeah,
Like,
for the most part, people are asking the same types of questions. So I could see how people could sponsors could become very robotic with it, and just kind of the words come out of their mouths, and whether they mean it or not, I could see how that happens. So I think that's very interesting. You mentioned limited partners. Find those limited partners And then from there, they're going to tell you who the good sponsors are.
Right, right. I mean, it's just like when I was looking for property managers for my turnkey rentals. I mean, they say, hey, here's a spreadsheet of all these questions for all these turnkey providers. And I created my own, and I got all the property managers, and I queued them up into interviews. And I was like, wow, that was an incredibly useless use of my time, because they all answered the questions the right way. I don't know who's good, right? I know they're all good at interviewing. Well, let's see if they're good at doing property management. So the key there was to find the other turnkey investors.
Yeah.
And I kind of just applied the same thing here.
Yeah.
Because those limited partners, they'll tell you whose deals are actually performing, and who are the good and lead sponsors, and who's got the track record. But it's a little bit tricky finding them, because I don't think it's cool to ask the general partner, well, tell me some of your sponsors, especially if you don't have a relationship. I don't think I don't think that's in bounds, in my opinion, to ask for that. You've got to kind of do a little digging on
Ask
your
for
own.
referrals or to.
Yeah. I mean, I don't think it's very proper. I think. I mean, if it was my investor investing in my deal, I'm like, well, I don't know who you are. I'm not going to go give you phone number and email address of one of my guys so you can bug him.
Yeah.
I mean, there's privacy issues there.
Right. Yeah, you got to be careful with that, of course, especially if you're not sharing that information out. You got to make sure you got permission to share that information.
Right, and especially if you're a bad syndicator, right? You don't want to be giving that information out.
Yeah. So when you're looking, let's talk about looking at a deal, because I think that's really important too. Because I think a lot of people, when they look at deals, whether they're looking at buying a deal for themselves, like you said, that first timer that's just going out there and they find a deal within the first week, or whether you're a passive looking at trying to find a deal from a sponsor, what kind of things are you doing to make sure that that the deal being presented to you, whether it's by the broker or by the sponsor, is actually what it is?
I think you have to have, I mean, there's a lot of good deal analyzer spreadsheets out there. You have to have some kind of system where you put the numbers in the same way, and you get the same outputs, and you're able to determine a kind of scatter point chart, how do they fall amongst the rest. But this multifamily apartments, they're not the most difficult thing in the world, but they definitely are 10 times as amount of inputs as a single family home. I mean, the single family home, analyzing that's like, okay, $1,000 rent, take 0.6% of that, or 60% of that, and that's pretty much how much you're gonna take home.
Right.
Well, the multifamily, there's a bunch of different inputs and outputs, determining that how much your take home is, and all kinds of things, especially if you're going to do some kind of reposition, have some kind of CapEx budget. So having one of those spreadsheets and getting a mentor involved, or getting somebody else to teach you how to use the dang thing, is a big part of it.
Yeah.
After that, I think I tell people, don't come and ask me questions until you analyze at least 50 of these things on your own.
Okay. Yeah. I would tend to agree. I mean, look at a lot of deals. Before I bought my first multi, I mean, I'd bought a lot of 1 to 4 units and all that kind of stuff, and even some smaller apartments. But I probably looked at 100 deals on LoopNet and analyzed them all. And, they're all not deals that work, but at least you're looking at, you're seeing the same things over and over. Like you said, you're putting in the same spreadsheet and kind of seeing the numbers and where they shake out. And then when you start looking at real deals, then you can kind of start to see those same patterns. So.
Right. And I think after you've analyzed 150 deals the right way, I mean, you kind of almost don't really need the spreadsheet to like filter out 95% of the junk out there. You can kind of do it on your own.
Yeah.
Yeah.
You can look at their numbers pretty quickly and go, nah, this thing doesn't work. I gotta just
Yeah,
decide.
yeah. I mean, some of those things that I kind of spot check without, because I'm lazy and I don't want to pull out the spreadsheet or get my laptop out. I'll just, I can, things you can pull up on your phone and just look at like, okay, what is he performing out the expenses at? Let me calculate the per unit expenses.
Yeah,
And if it's like something less than $3,000, I just chuck it in the trash because that's just not going to perform.
yeah, yeah.
You're going to need to see expenses more than that, or I look at the cap rate and the reversion cap rate. If there's that healthy 1% delta in there, it's enough to see, keep moving on. I definitely don't want to see the reversion cap rate go less or stay the same. So there's things that you kind of learn to spot check
Um, a
along
lot
the
of
way.
people probably don't know what that means. Can you explain quickly the reversion cap rate?
Yeah, so the cap rate is, is kind of easy determinable. You put in the spreadsheet and it kicks out the cap rate. What is this thing performing, without debt service?
Yep.
Let's just say it's 6.5, which is I think what most Class C properties are performing these days. What they teach us in multifamily investing school is that when you're putting this reversion cap rate, which is just one simple cell on the spreadsheet, what that does is it models out your selling cap rate in the future. So this cell is just a wild ass guess. So when it's a wild ass guess, you want to be conservative. So you increase the cap rate plus 1%, typically.
Yep.
People have different rules of thumbs. Some people are like 0.2% every quarter or something like that. But for the most part, since a lot of these deals are 5-year holds, repositions, it's 1%, just a good rule of thumb. So you put that 7.5 cap in the reversion cap cell, so you have that healthy 1% delta right there, and that's probably the biggest lever behind the scenes to pull as a syndicator. If you're not getting that 80 to 100% return in 5 years for an investor, well, bring it down from 7.5 to 7.1, and you've probably gotten from like a 75% a deal to 100% deal just by tweaking that one number.
Hmm.
So
Yeah.
it's just something
Yeah.
good to
You're right.
spot check. I
Yep.
mean, some people will say, they'll argue and say, well, we're making it go up from a C class to a B class or a B class to A minus class, and that's why we compress that. But I don't know. I mean, I don't know. I'm not going to invest. You can get somebody to invest in that one.
Well, and that may be true but then your going in cap, at least in the market, would be less. If you're saying we're buying a C class building in a B class neighborhood, in this B class neighborhoods, buildings are selling for a 5 cap or a 5.5 cap. Um, then your version could be at a 6.5 potentially on something
Right.
like that. But yeah,
Yeah. I mean,
yeah,
I actually did have like a 52 unit. I did, where we bought it at such a good price, where I think that thing was like performing at like a 9 cap.
well,
And then it was like, okay, well, so we're scratching our heads and like, okay, we can't put a 10 cap reversion cap rate. That's just
yeah.
crazy, right? Like, but I think on that one we actually made it like a 7.5. Like we did go reverse it just
So,
because the incoming cap was so high.
well, and I would assume, and maybe I'm wrong, but I would assume that you're looking at the market too and saying, well, most in this market they're selling at a 6.5 cap.
Right, right. You want to
Typical
take the prevailing market cap
prevailing
rate in
market.
that
Yeah.
class.
Yeah. So anybody who doesn't quite follow, I mean, basically, we're saying we're going to buy it at 6.5 cap. You're going to sell it at a 7.5 cap. So basically, when we go to sell it, uh, if the market takes a little shift, if we're not quite as aggressive in our market as if people are buying, we're still okay. Now you might sell it at a 6.5 cap because maybe the market doesn't shift, or maybe you can even sell it at a 6 cap. But at least we're conservative in our numbers, and that's what you're looking for. Somebody who's not trying to sell the dream. Somebody who's trying to be a little realistic.
Yeah, yeah. And I think it's kind of confusing, especially when you're starting out, and it's kind of counterintuitive because you're like, okay, you guys are being conservative, but you guys are increasing that cap rate. But I think you got to play around with the numbers, that dividing by the cap rate to get the value and see how the numbers play out. The smaller the cap rate is, the more is better for the sale. It's basically, because you're basically getting more bang for your buck with the NOI, and your sales price goes up.
Yep. Yeah. No, good points. Hey, I want to interrupt this episode real quick to talk to you about Nate Armstrong, our sponsor, Nate Armstrong. He's with homeinvest.com, and you want to get to know Nate. So go to homeinvest.com and just connect with Nate, talk to him, learn about his operation, what he's got going on. He's a turnkey provider, and it may not be right for you, but it could be the perfect fit. So it doesn't hurt. It's a free call, consultation, just to figure out, what they do, what they have to offer. And worst case is you're going to meet a great person who's really well educated in real estate. He's done a ton of different real estate strategies, and probably he's going to teach you a little bit, even on a short conversation with him. So go to homeinvest.com and connect with Nate's company. You're definitely not going to be disappointed. It's worth it. So thanks, and we'll get back to our show. Anything else that you're kind of looking at or doing when you're looking at these deals?
Yeah, I mean, the a lot smaller factor is like the occupancy. I mean, I think, like if you're modeling for like a Dallas property that's kind of in a hot market, I might look for like 92% occupied, and then a few points of loss to lease, or the other economic vacancy. But definitely you don't want to see anything higher than 95% occupied. That's just
for sure.
That's just smoking bakalolo, if you ask me. I mean, that's not good underwriting.
That's not realistic
not realistic. Yeah. And then the other thing is, looking at how much the rent's increasing every year, and how much your expenses are increasing. I don't know. I think 2 to 3% is a good, middle ground to sit. I don't know what your thoughts on that is, but
yeah, typically I'm, on my modeling, it's, my increases in expenses are around 2%. My increase in rent is around 2%.
Yeah. I mean, I think when you're seeing some of these guys like model it for 3 to 4 or 5% in like freaking Kansas or something like that, it's like, okay, you got to scratch it a little bit.
Yeah. If you can go at, honestly, if you can just go, what's inflation? Approximately inflation. You should be fairly safe. Of course, we can go backwards. We can always go backwards, but if you can just model everything based on inflation, you should be fairly safe, I think.
Right. And I mean, if we do go backwards, what I like about these deals is, you get in a deal that's non-recourse with a nice, 8-year, 10-year, maybe even 12-year note, that, maybe if the property doesn't reposition in 5 years, you're still cash flowing. Maybe it takes 7 or 8 years, but that you're still getting that cash flow from a stabilized property.
Yeah. So maybe now you don't make that, whatever they said, 16, 17% IRR. Maybe now you're making a, 14% IRR, but you're still making money.
Yeah.
So cool. Let's kind of move on. What's a biggest mistake you've made, whether you want to talk about the turnkeys, whether you want to talk about the passive, whatever, what's the biggest mistake you've made?
Probably the first limited partner deal I went into, that was way back in 2012. I had some money to burn in my self-directed IRA, a Roth IRA.
Sure.
And I asked my custodian, or not really I don't even know who I asked, but one of these self-directed IRA custodians, I asked them,
sure,
hey man, like what do people invest in, right? Because I didn't know any better. I was just investing in turnkeys at the time. And he's like, oh, you should check out this company, right? So I went and invested with them after very little due diligence, and and it turned out, like, I found out like a month later by going on Bigger Pockets that they were kind of a scam artist group.
Oh,
Um, I didn't get the nasty gram letter 2 3 years later that their portfolio had failed and their LLC is going bankrupt, and I had to take the property back, deed in lieu. But I basically lost most of that money because I guess they weren't doing their job on their end. It was it was just a lesson. Like, you don't work with people that you don't know, like, or trust, and you just have to build a relationship with people. And I'll add on top of that, you don't work with anybody you don't have 1 degree of separation with.
what do you mean by that? Explain that.
Like, you don't know somebody who's either been in their deal, and that's somebody we're talking about. You actually really know them. It's not like, oh, I had a conversation with them from website, or I met them at a conference one time. Like, you have to have a real conversation with
Yeah.
that one person.
Yeah. Yeah. No, that's good. That's very good advice. Get to know who you're actually dealing with. And so you,
Right. I think most limited partners out there, they don't go to conferences, they don't join mastermind groups. So they're kind of in a scarcity mindset. Um, they're kind of it's kind of a bad situation if you think about it in dating, right? Like, they're just going out and marrying the first person they meet
yeah.
essentially all the time,
Yeah.
especially when they're
They're
going
doing a lot of blind dates.
right. I mean, especially when, like, a limited partner wants to get into this and they just go to their local RIA, like I mentioned, is probably one of the worst places to be going. And then you're kind of working. I think you're working with that second rate
Probably
syndicator.
yeah, more inexperienced
Right.
syndicator, but
Right.
still
And it,
going to the local RIA.
right.
Yeah. Yeah. No,
Yeah.
good point. Um, so due diligence is really important, and not getting into a relationship quickly.
Right. Right. And now, since now I'm more of like a living a partner role, I kind of know exactly how this dance is being played. And when I meet somebody new, I'm like, okay, man, just add me into your list. I'm not going to invest in your deal. Like, don't even ask with me. I don't want to
Yeah.
sound like a jerk or anything like that, but I'm not interested. I want to see some deal flow. I want to see how your other investors take to the deal. If you're having trouble raising the deal and you're sending me 5 6 emails, I know the deal is not very good and your investor list isn't very good.
Sure.
I want to watch. I want to sit back and watch, and I just, in a way, you're just kind of dating a lot of folks.
Yeah.
But then, I kind of know what I'm going into at this point. But I
Yeah.
think that's a good way. Just getting a lot of people's lists and just comparing the executive summaries and getting repetition, because in the beginning it's a totally different game. You're not analyzing the deals per se, but you're analyzing the package and the sponsor.
Yeah.
Uh,
Absolutely.
I think if you notice, like, we haven't talked about anything about what's the sponsor splits, what are the prefs, what are the asset distribution fee, because at the end of the day, it's not really that important. I don't know why people ask those kind of questions. They're not really that important. Ask about the deal.
Yeah.
All that other stuff is just, how the deal is structured. It's important, but, you know, get your money secured first in the deal.
Yeah. You're caring about the sponsor, and you're caring about the actual validity of the deal, whether you think it can actually make money and perform where they think or not. Is that correct?
Right, right. Where too many limited partners, they ask, okay, what's the asset management fee? What's the,
Yeah.
distribution fee? What's the splits?
Yeah.
It's like, well, who cares if it's a 90-10 split if the deal is in, like, Jackson, Mississippi, with an assumption of 5% rent increases per year?
Yeah.
Like,
Not going to
it's just
happen.
not going to work. Yeah.
Yeah. So great that you're getting 90% of the deal, but you're getting 90% of nothing. That's still nothing.
Yeah. Yeah.
Yeah.
And let's not forget, you can lose money with these things too. So
Yeah. Well, you said one mistake. What's one success story that you want to maybe talk about?
I think it's just, for me, like getting rid of these turnkey rentals have been um kind of nice. I mean, I'm getting kind of lucky. I haven't held them onto them too long, but as they become vacant, I just put 10, 30 grand into it and fix it up retail.
Yeah,
Because they're just taking a long time to sell. I mean, a lot of my rental properties are like they're good rentals. They rent for more than $900 a piece, but man, they just don't move, especially when you're trying to get a decent price on.
really.
So yeah, I mean, I that's why I tell people don't go after like duplexes, triplex, or quads, especially if you're a high net worth, working professional. You're going to graduate to those syndications, and those are just going to be a nightmare to sell. I mean, I'm having a hard time selling mine, like I said.
Are they in more C class, D class areas, or are they in better
I
areas?
mean, I'd say they're in like a B minus area usually.
B
The
minus.
brokers may call it a B class, but you never listen to a broker.
Yeah, they're always 1 to 2 steps above. If they call it
Yeah,
a C, it's likely a
yeah,
D plus maybe.
right.
Yeah, that's good. Oh, that's interesting that you're having a hard time selling. I don't know what exactly the market, but
Yeah, I mean, you're just selling it to other like cheapskate investors or other unsophisticated investors who are trying to play the turnkey game
so
too.
you're not putting it on the regular market just to try to get like an FHA type buyer, or are you?
No, no, because there's a tenant. I have a tenant in there, so it's kind of hard to like kick the tenant out.
Sure.
Wait for the right time to kick them out and not have cash flow.
Yeah.
I mean, I like to stand and like have a good negotiation stance for this thing is cash flowing, and if somebody comes with the wrong price, I'm like, okay, I'll just hold on to it. You know,
Yeah. So you may
but
want
when
you may want to consider removing a tenant on one and trying that, because I just offered several properties. I've got a bunch of single family still, and I offered to get rid of them to investors, and I was getting prices bids at like 110, 100,000, 120, I think was the highest I got. I ended up selling it. I got rid of the tenant. We put about 10,000 into it, and I sold it for 170.
Yeah, I think I'm gonna have to start doing that. Thus far, I've been kind of just going with the natural flow in things. Is
Yeah.
people evict themselves and they move out,
Yeah. Yeah. Yeah.
then I kind of do that. But I'm getting to the last, I'd say probably about 5 or 6 left.
Yeah.
Probably gonna have to start doing that, or
Yeah.
I don't know, maybe I'm just
Maybe worth a
gonna
try.
hold on to it too. I don't know.
Yeah.
I mean, I think the getting the tenant is key. Like most tenants only stay 6 to 18 months.
Yeah.
But if you can get that one good one that they're likely to stay in there for years,
Yep.
I think that's golden.
Yeah. Those
And
are great.
I might just want to keep it onto it indefinitely, or around 5, 6 years or something like that.
Sure. Sure.
That's my thoughts.
Cool. Um, so how does, are you, when you're looking at these investments and you're doing this stuff, like how are you viewing the market, today's market? Where are we at? What kind of asset classes are you favoring, and maybe why?
I mean, thus far I've only been doing like in the multifamilies because that was kind of what I went and got the training for.
Yeah.
So I know it very well. I mean, in terms of the economy, I think everybody's saying, well, what if everyone's predicting, well, 2020 is like when the next collapse, or I don't think it's going to be a collapse, but
Yeah.
definitely be some kind of correction coming, since every, 8 to 12 years or some kind of dip or something like that. But I mean, as we mentioned before, if you're cash flowing and it's a stabilized property to begin with a non-recourse loan, I mean, I don't know how you can go wrong.
Right.
8 to 10% in a bad market is an awesome return, even if it dips down to 5%. That's better off than most people out there. So I think as long as you set yourself up in that right situation, I call it, that's how you hedge yourself. You can be pretty aggressive, and at that point, you just kind of buy new deals that make sense from an underwriting perspective, like how we mentioned, and you just keep investing. I think sitting on the sidelines is the mistake to be made.
Yeah, I couldn't agree more. Yeah, I think as long as an investor, what you just said there, I think is really important for people to think about is when a recession happens, um, everything's going to go down, or most things are going to go down. You're going to be making less returns. So if you can be okay with, like you said, going down to 5%, you're still making money. It's still likely better than most investments, even though you're making only that 5%. And the other thing that's to me valuable with real estate is you're still paying down the principal of the loan. So even though you're making 5%, if you factor in that principal reduction, you're making actually even more money than that as
All right.
well. So
And then you also hedge yourself with the value add opportunities, right? I mean, that's regardless of the market. If you can increase revenue by doing some reserve parking or
yeah.
some other way to make some revenue, then it doesn't matter if it's a good economy or bad economy. You're still going to get some absorption of that.
Are you looking for, when you're looking at investments, do you like investments that are fully stabilized right now, let's say 90% plus occupancy, or do you have interest in investments that are, well, let's call it 50, 60, 70, even 80% occupied, less occupied, but maybe more opportunity for a value add?
Yeah, I mean, right now I'm just looking at the first one you're mentioning there, that
Yeah.
90% occupied, Fannie Mae and Freddie Mac non-recourse loan. I'm still trying to build up my syndication portfolio. I've got about 7 of these deals so far, but I'm thinking like, maybe when I get up to 10, maybe I might want to go into a flyer, because I think this stuff kind of gets boring after a while, right? Like,
Same
oh,
here.
class C turning in class B, 3,500 of capex per property, blah blah blah. It's kind of boring. I mean, I think especially when those first 7 properties, if you're in for 50 grand a piece, I mean, at 10% cash flow, you're looking at 60 grand a year. I mean, you've got food on the table. I'm always a fan for going after singles and base hits, and then when you get food on the table and you've got that, that cash flow coming in, let's go and get some home runs. Maybe that's the time to go invest in a development syndication or one of these more hairier deals,
Yeah.
as a minority part of your portfolio.
Yep. Yep. Yeah. No, good points. Good points. Um, so take us through this kind of mind shift of, you're this engineer, you get this, you're still working as an engineer, and but now you're doing this real estate. Take us through that mind shift. How did that happen, and what kind of clicked for you?
I mean, my first job was pretty difficult. I was like traveling like 100% of the time, and I didn't really like my boss's boss, and they're kind of jerks in a way. They treated people not the best way. Um, I I just kind of had a realization at that time when I had like 5 6 rentals definitely on my way, and I was like, wait a minute, I make more money than you guys, like, and this is just always gonna keep steamrolling forward.
Yeah.
Like, why do I like this? That's just blood money at the day job. Like, why do I want to take on 8 to 10% more pay and a promotion, or I have to deal with 50% more junk? I mean, I'm no idiot, so like those percentages didn't sound right to me. So the way I think about it these days is like, I take a look at everything I do, and like, it's what's my hourly rate in doing that. If it's
Sure.
less than what I'm doing in real estate, then I don't do it. So a lot more things is, trading time and money are 2 resources that are interchangeable. If you don't have money, you should have time to do it yourself. Like, you do your own laundry or cook your own meals.
Yep.
Um, I think that's what I'm kind of working on these days is, trading, I've got a little bit more money. So how do I get back time?
Yep. Cool. Um, 3 factors to your success.
Um, I think I'm pretty good at, getting things done. That's David Allen's book, GTD. So I get through my emails every day. I use a lot of filters and um, what do they call it? Labels. I drag them into those folders on the side.
Sure.
Um, just having a good system to get through everything. Second, a big routine person, doing the same things every day, and then slowly tweaking small things every day as you go along. And then the third thing is, I think self awareness is a big thing that people they don't realize. I have a lot of calls with folks who kind of connect with me, and it's just one takeaway I've had is like the successful people are very self aware. Where I was trying to get to the point where I'm like, okay, what do you have? Time, money, or knowledge, or network? You have like figure out what's your competitive advantage, and then go all in on that.
Hmm.
Most people they have some kind of skewed reality of themselves, and they're just doing the totally wrong thing. And those are always the people that don't listen to anybody too. So I think Gary Vaynerchuk, talked about that. Self-awareness is one of the biggest traits as an entrepreneur to
Yeah,
have.
for sure. Cool. Um, so how do you've got this podcast? Talk to us a little bit about that. What's the podcast about, and how do people get listen to that?
Yeah, so I fell into love with these podcasts back in like 2010. I listened to all kinds of like CrossFit and paleo stuff. Definitely changed my life. So I really liked the format. So in 2015, 16, I was getting into these double digits of turnkey rentals, and obviously all your buddies ask you how you're doing it, and none of them do it,
Yeah.
and you get frustrated and like annoyed because everybody asks you the same damn questions. So I made this podcast to kind of like answer those questions, and like just being kind of like follow the journey kind of a podcast.
Sure.
So that's how it kind of started. But in the last like year, it kind of morphed into more. I mean, obviously, I'm not beating on the turnkey rental drum anymore. I'm doing more of a limited partner thing. But um, yeah, it's kind of just I kind of just follow along on my journey, meet these different characters like yourself along the way, pick up what you can, and just I think it's kind of personal. I think that's why people like it for some
Yeah.
strange reason. I always thought about making like a Mr. Money mustache for real estate investing. Yeah.
And what's the name of it?
Simple passive cash flow.
Cool. Last question before we wrap up. What are your three pillars of wealth creation?
I think it's I got three rules, and first rule is buy real tangible assets, hard assets. So that's real estate. That'd be gold. Gold's a real hard, tangible thing. Examples of not that is the stock market, right? I mean that's all paper assets, goes up and down all over the place. The second thing is something that's leverageable. Real estate's that, right? You can leverage that thing 4 to 1 typically. Um, and then the last pillar is going after things like cash flow, because I mean I think my goal when I began was trying to get enough income from these passive investments where it replaced my income and I can escape the rat race. Um, and that cash flow is important. I mean things like gold, it's a hard tangible asset, but it doesn't produce income and it's not leverageable.
Yep.
I mean maybe technically if you buy mining stocks, but that's a different story.
Yep. Yep. Yeah. Well, I like it. I like all those. So, uh, last question or last thing is how do people get in touch with you?
Yeah, you guys can come to Simple Passive Cash Flow or check out the podcast, simplepassivecashflow.com. Or, just shoot me an email, Lane at simplepassivecashflow.com. I think that's one of the biggest ways I've progressed is just, um, pick apart other people, what other people are doing, and kind of taking what I can from them. And hopefully I add value to different folks too.
Absolutely. Awesome. Well, Lane, I appreciate you coming on the show and spending and waking up nice and early and spending time with us today. So, yeah, appreciate that.
Yeah, it was worth it, Todd.
All right, my friend. Have a good rest of the day.
All right.
Hey, special thanks to Lane for joining us on the show. I appreciate the time that he spent with us. A couple of things that I took from him. When you're getting things done, he talked about using filters, using labels, using routines. So those are really important. Definitely, those labels and those filters are extremely important on your, on your social, on your emails, that type of stuff. And then he also talked about self-awareness. Make sure you're self-aware. You understand what you're doing right, what you're doing wrong, and how you can grow and expand. Then the other thing he talked about, and this was basically when I asked him what was 3 pillars, he talked about making sure you've got cash flow, and I think that's really important. Especially a lot of people think about appreciation, but we just should also be, or actually, we should mainly be focusing on cash flow. Appreciation should be more of a bonus versus the other way. So. Great stuff from Lane. Appreciate him coming on the show, sharing his insights, and taking time out of his day. We would love to have you subscribe to the show. We'd love to have you go onto iTunes, give us a rating and review, and subscribe. Just keep on listening, keep on sharing this out to your networks, so we can continue to grow. We can continue to provide great content. So, thanks everybody for listening. I'm Todd Dexheimer, and I'm signing out like every day is Saturday. Are you ready to start investing in real estate today but don't know where to start? Sometimes investing can seem way too complicated, but it actually couldn't be any easier than with HomeInvest.com. You know the co-founder and my friend Nate Armstrong. He appeared on episode 20, and if you haven't heard it, go back and listen to it, episode number 20. Home Invest is a company that allows you to invest in turnkey real estate. Their goal is to build powerful investment tools that make real estate investing accessible to everyone. They have contractors and property managers available for you with the click of your mouse. While other real estate agents can only offer a property, Home Invest brings you a full turnkey package that allows you to diversify your investments, earn passive income, and start building equity in properties. Their simple, intuitive design allows newcomers and experienced investors alike to hit the ground running and to be able to choose the properties when they want and where they want. View easy to understand charts and data to allow you to buy in only a few clicks or just a simple phone call. With Home Invest, you'll be building your portfolio as quickly or as slowly as you would like. And right now, Home Invest is giving our listeners, Pillar of Wealth Creation listeners, a free course on how to finally win in real estate investing. So go to homeinvest.com/pillars. That's homeinvest.com/pillars to claim your free course today.